course, get ready for the weekend. We will be back next Friday, even though we have a shortened trading week. But again, remember, there's a shortened trading week next week. All right, now all that being said, I'm going to navigate over to the PowerOptions suite of tools. We are going to use that to illustrate our discussions for today's presentation, as always. Let's see here. So let's just go ahead and get over there. Perfect. All right. So our first question that came in, before I get to that, Jerry's question, Jerome, before I get to that question, I just want to remind everyone, if you're just getting started with the PowerOptions suite of tools, go ahead and make sure you take advantage of the 4 steps that are listed here on the trial. The free quick start guide, go through the flash tutorials to get familiar with some of the tools. There's a variety of archived webinars as well as live webinars that you can access at any time. And of course, schedule the free coaching session, which is a one-on-one conversation with myself or Ernie as well. Okay, so I just wanted to point that out. Now, Jerry's question is related to the radioactive trading techniques and doing one of the income methods of the 12 that are listed. There we go. So the radioactive trading techniques, we start with a specific structure. Oh, wait, I didn't want to go there. Let's just go here. A specific structure of a stock plus put combination to give us the preferred risk that we want, single-digit risk on any position. Then we might use any of the 12 income methods to help further reduce that at risk and potentially bulletproof the trade, meaning we have a guaranteed exit that is higher than our lowered cost basis by, of course, adding the different adjustments and generating income against the already low risk position. We do go far out in time with this put to give us more time for the stock to move in our desired direction and to experience less time decay. That puts more expensive up front, but the cost per day and the theta, the time value decay, is lower than buying something near term that's actually cheaper. That's all discussed in the blueprint, the full setup, of course, and the 12 different income methods that we use. Now, Jerry's question is, he did his first income method number 1. One of the 12 income methods was selling a call at the 42.5 strike at PAGS. If the price exceeds the call strike and I decide not to roll the call and let it get assigned, how should I handle the put? All right, well, let's take a look. I'm not going to specifically do PAGS. Oh, I will. Okay, let's just go to the custom spread tool. Rather than take a brand new one from the search here, which would show which married puts we would get into today, I believe that, yeah, same thing. EDU is still up at the top at 96.58. It's been moving up a little bit today. But I'd prefer to go with a January 100 put for a risk of around 8.5%. Typically, I keep my risk lower than 7.5%. All right. But for Jerome's question, I'm sorry, let's go to the custom spread tool, and I'm just going to build a PAGS position on the fly around perhaps where his strikes are. So let's say that a while back we bought PAGS at a lower price. It's at 38.97. So let's say we bought it maybe at 38 even. Okay. And at the same time, would have bought maybe a January 42.5 strike, and that probably would have been around the 790 range. So I'll put in 100 shares here at $38 even. I'll buy that one put at 790. I don't know if this would match my criteria for this position, but it likely would. I don't mean not that it didn't come up in the search. I mean the risk threshold there. Let's see. So here we're 7.4%. I'm sorry, folks, 7.4%. We'll leave that as is. Fantastic. Okay. Now, as the stock moved up a little bit, now you said you sold the 42.5. Okay. And let's say that we sold it for July. Well, not a lot of premium there, 30 or 40 cents, but I can't sell the 40. That would create a bearish position. But let's say we got 50 cents for this short call. Okay. Now he's going to remain in the position. And of course, what does this create? Well, we created a collar. This is income method number 1. It's given away for free in the sketch. You can just go to radioactivetrading.com, click Get the Sketch, and you'll see sort of a discussion of the first income method, which is the most logical. Hey, I'm in the married put. It's far out in time. As the stock does what I want, let me sell a call here. That'll generate income. does cap the upside, and now in this case we've added an upper and a lower break even. You can tell just by looking at the chart that some of the basics for this particular income method would be that I don't expect the stock to move too much more beyond this direction. If I had expectation the stock was going to go on a run or earnings were coming up and it might be trading at 47.50 or up to 49, I'm probably not doing this adjustment. I expect it to be around the same price. But Jerry's question is, if he leaves this position alone through July and the stock's trading above this price, and instead of buying it back, instead of rolling the call, he allows the call to be assigned, what's going to happen? Well, he's going to lose the stock, call is assigned, and he's left with the long put. So his question is, what do I do with the long put? That is discussed in your blueprint, Jerry. There's 3 things I can do at this point. I could do an income method number 7 if I allow myself to be assigned on income method number 1. You can read about that in your blueprint. If you've decided you're out of the position, what's going to happen? Well, let's go to expiration. Let's put the stock at 40. Well, let's put it at 44. Okay. And we'll go to July expiration on the 19th. Why am I showing this here? Because see, even though your put is now out of the money, stock's at 44, your put's at 42.50, it is still a January 2020 put. Its theoretical value with a current implied volatility of around 0.47 will be $477. Yes, you took a loss on it, but you would have gained on the position. And by the way, this gain here, this 5.4% potential return, is including the value of the put. So if you got assigned on the stock at 42.50 and with a $4.77 value on your put option, this would be the peak return of $247. Okay, take the profit on the position, sell to close the put. You do lose on the put, but you've made on the stock position the stock appreciation from your purchase price. Okay, and that's what we want to see. So if you've decided you're done with the position, you let your stock be assigned as you mentioned, SGN. Okay, you let that be assigned, and then you would sell to close the put. That would take your max profit. You'd be out of the position. Number 2, if it's just a little bit above 42.50, you've got this return here. It's around 42.80, 42.90. You still let it be assigned. Well, depending on what your cost is for this put, and depending on what profit you've taken in that would lower the cost basis, you could simply buy the stock again, and you'd probably be continuing the married put with about the same risk of 6.4% from my example. Okay, so buy the stock again and continue the trade. Now, I'm not going to give it away for free, of course, but the other alternative you could do is if you decided not to roll or not to close the call before you get expiration, you get assigned, is you could use income method number 7 to stay in the trade. Again, read that chapter and evaluate the SIGA model and see if income method number 7 would match your goals for that position. Another alternative that I don't know if I'd really do, and it again depends on the profit that you have here from the stock, growth, appreciation to your call strike price, and the loss that you have on the put. If the January now 42.5 call is at a lower cost basis than the profit you accumulated, the appreciation on the stock, you could potentially buy the call with the profits and still have a relatively low risk straddle or strangle going through January, depending on which strike you select. If there's any risk at all, remember you'd still be taking on 100% risk of what you have, but you're only keeping that number of contracts. It is an option. This is similar to what's discussed as an alternative to income method number 4 when the stock is moved up. Okay, so you could potentially buy the call to create the straddle or strangle. What does this all depend on? Well, as you know, Jerry, that's going to depend on what we call the SIGA model. For each of the income methods discussed in the blueprint, we discussed the SIGA model, and for the potential trade itself, what does it mean? What are the current conditions? Well, my stock's moved up, I let it get assigned. Am I still bullish? Do I think it's going to pull back? Am I bullish on the market? Am I bearish on the market? That's going to determine what to do next. If you were bearish after this move, you allowed yourself to be assigned on PAGS and you're bearish, maybe leave the put open. Maybe the stock falls. Maybe that put increases in price after this move upwards. Okay, that kind of goes into the expectations. So what are the current conditions? Hey, I got assigned on my call. I'm holding a long put. What are my expectations? If I'm still bullish, well, sell to close the put because it's just going to lose value if the stock keeps going up, or buy the stock back. If you're neutral, maybe just sell to close the put. Be done with the position. Take your profit. Why hold a put that's going to lose time value if you don't think there's going to be much movement? If you think it's going to fall, leave the put open. Maybe it falls and you get an increased value or higher price for that put as well. Or, depending on the SIGA model for income method number 7, did that match your expectations? The goals, what is the goals? You've taken a profit here of maybe about close to 5% on the stock, but that you're not fully achieved on that 5% yet because you haven't sold to close the put. Okay, so you've got a gain in appreciation on your stock. You let it be assigned. You've hit a target, and you know your target if you sell to close the put. If that meets your goals, do it and be done. If you think there's more potential for profit, whether the stock falls or moves up, decide do you want to buy the stock using income method number 7, buy a call, or just get out. Those 3 determine your actions. Okay. All right. So yeah, and Jerry says that he originally bought the stock was at a 31, and you bought this put when the stock was at 37, so it was a cheaper price and you locked in gains. You might already be bulletproof already. That doesn't change really. All it changes is the number we're looking at here and the graph. Okay, that doesn't change the concept of what you would do afterwards. You let it be assigned. What do? Buy back the stock if you think there's more upside. Sell to close the put if you're happy with your profit. Use income method number 7. Read about that this weekend. Maybe buy a call depending on the value of the appreciation, and if you can enter a straddle or strangle longer term that has no risk. Okay, so those are what you would consider if you let yourself be assigned to move forward. Okay. Normally, we would, of course, adjust that as well. We would use income method number 2 or adjust the position before, maybe convert it to an income method number 6 before letting it get assigned. But again, that's more talk of the blueprint. This is the same thing that I would consider doing if I was in if I was in sort of a diagonal calendar spread and it moved up and I was assigned. Well, most likely my broker would exercise the long to deliver the short. Has a similar profit and loss chart. Or even if you're just in any kind of dynamic collar, what happens now? My put's 2 to 3 months out and I get assigned on my call. Well, buy back the stock if you think there's more growth potential to the upside. It'll change your cost basis, but you've got some of the profit already realized. Sell to close the put if you've hit your goals. You think it's going to decline? Hey, maybe leave the put open. And if you have enough cost where you could buy a call further out to create that straddle or strangle with no risk whatsoever, maybe consider that. Still leaving the put open, but then adding the extra call to it. All right. That's my brief synopsis on what I would do if assigned. One quick moment here, 78-minute mark for those of you who are interested. I saw a few moments ago, USA was still up on France in the Women's World Cup there. 2-0 at the 78-minute mark. I'm just going to refresh real quick. It might even be over now. Oh, no, it got a little bit more interesting here. There we go. It's now 2-1. Right at the 90-minute mark, right at the end. There's some extra time, but it's now 2-1 USA over France. For those of you that are interested, we'll go check that a little bit moment on as well. All right, now let's see here. Bob. Hello, Bob. How are you doing? Bob says, I have been using PowerOptions for many years and I love the tools, but I would love to see some additional strategies supported. Okay, ratio spreads, call and put butterflies, and others. Do you have any plans to add additional strategy support to PowerOptions? Potentially, yes. Okay, now there is, let me go back here. What was the second part of your question? You had mentioned butterflies. We show the iron butterfly, of course, as you know, Bob. But just call and put butterflies. Yes, that's probably the most likely thing we would do next if we expand the strategies. It would probably be the call and put condors and call and put butterflies first. There's a tool that we have, one of our signature tools called the spread chain tool. Okay, and this allows you to view certain things one stock at a time as a credit spread view, So here I could sort of build my iron condors. I've got the bull puts on my right and the bear calls on my left. I can build the debit spreads. This, I'm sorry, the put credit and call debit parity, and the call credit and put debit parity. To be honest with you, it is unlikely when we get to it, Bob, with the ratio spreads, that we would create a tab to have a search for the ratio spreads. All right, there's a couple reasons why. Number one, it's not frequently asked about. Number two, the search capability, in my discussion with the programmers, the search capability for that is made more difficult by the fact that you might want a 2-to-1 ratio, Bob, and that's fantastic. You might want back spreads, you might want forward spreads. That's great. You know, if we create 2-to-1 ratio put spread search, then someone's going to want the 2-to-1 ratio back spread search. It just makes sense. We understand that. It would take a little bit of time. Over my 18, 19 years of teaching options to investors, one thing I found out that no matter which way is discussed to do something right, or the newest idea that came out, everyone tries to improve it. What do I mean by that? You might want to do a 2-to-1 ratio, but you found in your trading that a 3-to-2 ratio actually works better. Meanwhile, I've got a customer who's asking about 5-to-3 ratios. I've got a customer asking about 7-to-5s. It's almost a never-ending struggle to see which ratio you want. So the search, the way it might work, could handle most of that, but not on the same screen. It would be a difficult toggle to go back and forth. Why am I going through all of this anyway? Likely the first thing you'd see would be a tool such as this nature first for one stock at a time, where you'd be able to look at ratio spreads. You'd have a tab for ratio spreads here instead of credit spreads, back spreads instead of debit spreads, and reversals and so forth. And then you'd probably have a pod in here where you could type in which ratio you want, 2-to-1, 3-to-1, 4-to-1, and what kind of minimum net credit, in the money, out of the money range, spread width, and so forth, to try to narrow it down. That's probably going to be the first thing you're going to see. I don't have an ETA for you on that at all, but for us, that's the logical step to go to at this time, rather than a search of that nature, because the complexity of everyone wants a different ratio or everyone wants that different kind of setup, is to allow you to plug in what you want here, but instead of scanning across the universe, you can do it one stock at a time. Most logical thing, Bob, honestly, if we added next would be, I don't have it, oh, I do, I have the iron condor on here, but we'd be to add, as you mentioned, so of the iron condor, a search for all call or all put butterflies and condors as well. That'd be the easiest because it's more simple to do than accidentally slipping down the rabbit hole, for lack of a better term, of the multiple ratios that we could use in that situation. We'd leave it up to the investor to tell us which ratio they'd want to see, but rather than creating a new search around that, we would allow them to just look one stock at a time at first until that could happen later. So thank you for your question, Bob. One of the reasons why you haven't seen things such as ratio spreads, all call or all put butterflies added in the years that you've been a loyal PowerOptions subscriber, and we greatly appreciate that, is due to the fact that probably only once or twice a year do we get asked about it. Most of our customers aren't using those. We run that survey, as you know, Bob, every year, and we take into account to the strategies suggestions that any PowerOptions user answers during those surveys, and we put those on the list and we rank them in order as well. So as I mentioned, I think the next strategy that will come out will probably be either all call or all put, condors or butterflies. I don't know which one would come out first. And then after that, you might see that ratio. You will at some point see that ratio spread tool out there, but it won't be a ratio search. That's what I know is going on in the background. But the programmers are working on a few other projects beforehand, background things you won't really see, changing sort of the formats and the background coding of the website as well. Faster performance, better views, and more. All right, let's go ahead and check here real quick. And all right, looks like the game has ended, ladies and gentlemen. So those of you who were interested, that last half hour there, the U.S. did beat France in the quarterfinals 2-1, and there's that double header going on tomorrow as well. All right, back to PowerOptions now. Okay, so I don't, oh, interesting question here. Let me see if, oh, okay, good. Fernando asked me a question via email earlier today. And Fernando's question was related to the married put structure. And what is one of the things that we know? I don't have slides for this. I emailed it to Fernando and took a couple screenshots, but I don't have slides for it. What is the one thing we know about the married put? And what is the one thing that, since I was introduced to the radioactive trading technique, started using it in my account and started teaching it for everyone and started showing my examples as well, what is the one thing we know? Well, the put option itself gives us that controlled risk as we saw, okay? And we can keep it to single digits, which is what we want. The first thing a new options investor or an investor who is trading covered calls will say anytime they see the married put strategy up front is say, why are you doing that? You're buying a wasted asset on a position that you're bullish on. You're buying a bearish position that's going to waste time value that you're bullish on. Well, that's true. But see, what's interesting is just what we showed earlier. I'm going to show this real quick just to illustrate this point. Then we're going to talk about theta a little bit. But what's interesting about the married put structure done properly, following what we call the 3 core principles of radioactive trading, which really applies to any strategy, is we want to take advantage of what's known as the ATM bell curve. We want to buy slightly in the money or slightly out of the money because the highest time value is always at the money. That's where you want to be selling, is at the money, not buying. The option that is further out in time, let's say 6 months out in time, is not 6 times the cost of the current month. It's not linear. You pay a lower cost per day. So it's better to be buying options that are farther out in time and selling options that are closer in. That's the time value decay. The option that you buy that's further out in time will see a slower time decay. It will have a slower theta. Whereas when I'm selling shorter term, month by month, I'm going to have a much higher theta on the position. Okay? What's interesting too is, let's say that we go to July. Remember, I'm sorry, let me talk about this structure. Buying this shares, our example that Fernando and I were talking about earlier was this was at $96 even, and the 100 strike January put was at $12.40. Okay, so that looks expensive, doesn't it? We're 4 points in the money, so we're paying $8.40 of time value on this position. But it's to January. The risk is 7.7%. Now, if the stock does not move, let's say the stock goes right up to 100. On July expiration, 19th, 21 days away, we might expect to lose about $242, okay, in time premium decay. We lost intrinsic plus we lost time. Let's look at it this way. What if the stock stays exactly where it is right now at 96.58? We're going to lose $85 on our 100 strike put. Okay, that $8.40 of time value we paid in, we're only going to lose 85 cents of it. Okay, but it's because that's a low theta. It's out to January. Now we go to July. If I bought the 95 put, the cheap put, for only $230, and I hold this all the way to July expiration, what's going to happen? I'm going to lose $250. That time value decay is higher and it's much more rapid. The theta is much stronger. Buy the 100 strike put at $5, less than half the cost of the $12 I would spend to buy the January put. But again, what happens if the stock is trading right where it is right now at 96.58 to July expiration? What are we going to lose? We're going to lose 178. We're going to keep the time premium, still 342 in the money. We're going to lose 178. Twice the amount of money, the time value we'd lose by buying the further out in time option because the time value decay is slower. So where I'm going with this is that when you say you see a cheaper put, this put here, it's only $230. Well, it's the 95 strike put. Now the insurance doesn't kick in until 95. You didn't pay $12 for this put, but what's going to happen is you get closer to expiration. This is going to go to 0. January put still has most of its time value remaining. 100 strike put would lose, but it would keep its intrinsic even if the stock stayed the same. And that loss would be double of what I would experience with the January put option. So why go through all of this? Well, Fernando's question was an interesting one I have looked at in the back of my mind, but haven't considered looking at it in this way in relation to a protected position or the proper structure of a married put. And his question was, is there a way that I can use a directional protected position, which is what this is, and still have positive theta, so as time passes, I'm getting premium? Okay, the answer is yes, naturally. But what do you have to do to have a positive theta? What is theta? Theta is the rate you'd expect of time decay on the option as you get closer to expiration, assuming the stock price doesn't change. It's a negative value. It's decaying. How do you get positive theta? You have to sell something, a call or a put, in order to get a positive theta in your favor. What's going to happen to this structure if I sell a call or sell a put? I'm changing the dynamic of the trade, as we already saw with the PAGS example as well. And you can apply this to other things. Think about this as just a long call for a moment. It's not, the long call is not a parity trade to the married put. Okay, the long call with money put aside that you would use to buy the stock could be considered a parity. But once you just invest in call options, you're now risking 100% of the position. Okay, so how do we get first things first? This is exactly the process I went through to answer Fernando's question via email. First thing I have to know is, well, the stock doesn't have a theta, but what does? The option. So I've got my January 100 put. Let's check on option research. It shows me all the data we have for the option, and close to what we had earlier today, Fernando. There we are at negative 0.0232. What does that mean? It means that every day right now that the stock stays at the same price and we get closer to expiration, I'm expected to lose about 2.3 cents. Okay, over the next 203 days to expiration. Okay, that's what that theta means. So now I know it's negative 0.23. What do I want to do? Well, I have to sell something that has a theta higher than that. That's really easy. Okay, the near term 100 calls at 170. So with only 21 days to go, this theta is going to be at around 8 or 9 cents per day. The 95 put is at about 230. So it's actually going to have a higher theta. And let's just use the 90 put. That's at 105. Midpoint-ish. So let's say I sell the 90 put. Okay, what's the first problem we're going to see? Well, number one, we got a price midpoint of 103. So we've got to lose about 5 cents every day for the next 21 days. And it's not exactly like that. It's not 5 cents every day. Even though we're 21 days out, you're going to see a slower decay that's going to pick up drastically the last 3 to 4 days. Okay? Now, what about this particular option? Remember, we have to beat a 0.232 theta. We sell the put now, so it's still negative theta, but it's positive in our favor. And whoa, perfect. We're at negative 0.0573, all right? So we're at a positive theta now of about 0.35. We're going to get 3.5 cents per day with this structure. But what just happened? My risk goes up now to $9,737, or 90.7%. Upside is still infinite. Why'd the risk go up so high? Your long put can either only cover the stock or the naked put. Doesn't work that way. It can't cover both. So now I have another obligation to buy shares of stock. I may not have to put up the margin requirement depending on how my broker reads this 100 versus this 90. But again, I have a long stock position. If the stock falls to 85, that long put can either only cover the short put, and I have an $11 loss on the stock, or worse. Or it covers the stock, and I've got a loss on the short put. How do we stop that? Add a long put. Okay, so let's make a bull put credit spread. Add the 85. Okay, so now this is not an income method. This is something I would never do in a married put or radioactive trade, but I'm showing it as far as theta goes. Remember, we started off with a negative theta of 0.0232. And we sold that put for a which had a theta of 0.0573. So we're at a positive 0.34 theta, 0.034, 3 at 0.4 cents of positive theta. Now we add this extra one, and as long as that theta is below 0.34, we're still good, and it is. It's only at 0.278. So now what do we have? We have a new structure where my theta is going to be positive by about 0.007, 7/10 of a cent per day. But how did this change the structure? Did it leave the upside open to keep the direction? Yes, that was one of Fernando's qualities. Are we now in positive theta? Yeah, for 7/10 of a cent per day. Did we cancel the obligation here of the risk? A little bit, but we have to add $5 onto our existing risk because of the strike difference. So our risk goes up to 11.9%. Is that still the structure that you want? Answer is probably no. Okay? Because of the downside risk almost doubled. Not quite, but it almost doubled. But it is positive theta. The best way to do it is something that's in the blueprint, which I talked to Fernando about. I could do it on the other side and create a positive theta with income method number 6. One of the ones we use, but it changes this dynamic to the upside, and you'd have to make sure it matches your goals for that as well. Okay? So I'm not going to go into that. I just wanted to review it as far as, remember, if you're thinking that you want a positive theta, what do you have to do? You have to be short something. And if you're in a protected position, you're in a long call, you're already in a diagonal spread that probably has a positive theta, but you want a little bit more, what do you have to do? You have to sell something so where that theta decay works in your favor, right? It makes common sense, but it's not so simple. A lot of these comments, a lot of these things that are out there, gurus, self-proclaimed gurus, actual gurus, even who talk about the concepts of delta neutral, theta neutral, gamma neutral, and more. At the end of the day, what you still have to pay attention to is, what did you do? What do you have to do to get to that gamma neutral, that theta neutral, that positive theta, this positive gamma, this positive delta ratio? What did you have to do to get that? And does the new structure you had to create to get that specific Greek structure really match what your trading goals were for the stock to begin with, or the strategy to begin with? And it probably doesn't. A lot of times I've had discussions with investors who said, well, I was worried about my delta exposure, so I sold a far out call, sold a far out of the money put, and bought a call as well further out than that to create a positive delta position. And I said, well, you realize you just doubled your risk. And they said, no, I still have a position here where I've got a long call, a spread on top of that, and then a short put that's so far out of the money that it can't be hurt. You know, you're 2 strikes out of the money. That can get hurt. Now you don't have the risk of the long call. You've got the risk of a cash secured put. And nothing that you did on this call plus call spread structure on this side can be used to lower the margin of the put on this side. So now you've got to put up the money to cover that put as well. But I'm delta neutral. That doesn't matter. What are your rights and your obligations? It always comes down to that as well. You've got to keep that in mind when we start playing with the Greek concepts, to remember, what dynamic are we actually changing? Does the new structure still even support our expectations for the position going forward? And did we just completely destroy what protection we had by adding a margin or adding a full naked risk to the trade as well? That's what it all comes down to. All right. Nothing wrong with being theta positive, don't get me wrong. I love time decay in my favor. It's awesome. But again, I don't want to overdo trying to force a positive theta position if it counters the risk and counters the initial expectation of my stock going forward, or the underlying. Let me just say the underlying, because I might have been in a bull put credit spread. I might have been in a calendar spread. It doesn't have to be married put. All right, so Darrell, UTHR, here's a specific trade question. UTHR, long 500 shares. And I'll just assume a price. And you say you want to buy 15 calls and sell 20 near the money. Okay, what can happen if sold option goes in the money. Oh, okay. So let's just take July. And from what I'm reading here, Darrell, you want to buy out of the money calls and sell 20 near the money. You're entering a bear call credit spread. So stock's at 78. You're going to sell 20 80s, buy 15 85s, okay? I'm just going to use this as an example. I'm going to put your cost basis at 76, so you've got some unrealized gain. Now let's call it 75. You've got some unrealized gain in the position. I'm selling 20 80s. Yes. And I'm buying 15 85s. What is this doing here? Okay, well, what's going to happen is he's not naked, thankfully. You're entering a 15 contract bear call credit spread at 80 to 85. So you're going to need the 5-point margin between the strike prices times 15 contracts. And the other 5 contracts aren't naked because it's a covered call. Essentially, you've got a covered call with 5 calls at 80 against your 500 shares. And you've got a 15 contract bear call credit spread with a 5-point difference. This is what your graph looks like. You now have 2 ways to lose. Of course, your cost basis might be different. You might not be seeing it go negative to the upside. What would happen if the stock is trading at $83, right around your break even here, upper break even, 83.35? What happens if the stock's trading at that point and you didn't do anything by July expiration? You get assigned on your 500 shares of stock. Okay, they're gone. You've got a significant profit. The long calls expire worthless. They're gone. Stock's at 83. You're out of the money. Long calls expire worthless. You have an obligation to either be short 1,500 shares, right? Because you sold 20 contracts, 5 of them were covered. This is covered, but you had to put up the margin, $7,500, in order to place the trade because it's a bear spread. The call's not at a lower strike price. It's not a debit spread. It's a credit, which you were looking for. But again, you have to cover that margin at $7,500 additional dollars. Okay, now you have to be short 1,500 shares of stock or pay the price to buy back 15 calls at 85 cents. No, these were 80s. I'm sorry, 334. My apologies. 1,500 at 334. Or you're going to be short 1,500 shares of stock at 80. Call does nothing. Okay. What happens if it goes above both strike prices? Well, you get assigned on your stock. You lose the 7,500 on your bear call credit spread of 15 contracts. That's why you're at the loss here of roughly $2,500. Well, yeah, 2,500. It looks like 2,430 is the max loss anywhere above this line. It doesn't increase. This 35,000 new risk is to the downside because you did collect a credit, but it's still the stock position. That's your risk. Okay, so you'll get assigned, but then you still have 15 essentially naked calls open when the stock is between the strike prices. If you don't do anything, you'll wake up Monday and see you're short 1,500 shares of the stock, UTHR, at $80 that's currently trading at 83.34. Or you could have bought those 15 calls back for about 335, 340, depending on where the stock was. But anywhere between the two strike prices, 80 and 85, that's what would happen. You see the graph here of what would happen if the stock was trading above 85. You lose the 7,500 on the spread, still get assigned on the stock, and you're out of the position for a small loss, about $2,450, $2,400. Using my numbers. That'll be different based on your underlying stock price in that case, okay? All right. Follow-up question related to this. Darrell says, does the PowerOptions program contain a trade journal or portfolio manager to keep track of the trades? Yes. When you're tracking any position, enter any position in the portfolio. So, let me see here. Add to portfolio. Okay. I'm just going to add this one in. It's going to show up as a custom spread, but that's fine. And we'll call this July 28th. Covered bear call. Why not? All right, but anyway, in any case, Darrell, sorry about that. Let me just put this in here. So I'll click Insert, and there we go. It's going to be different prices, of course, so we're just going to go ahead and do that. Now, this is just one position. I'm doing this for the ease of view. It does register as a custom spread. This isn't really a covered call with an extra long call on it. It's ratioed in a sense, and it's okay. But it's called a custom spread. It doesn't really have a name. Anything that we don't have a distinctive name for, it goes in this custom spread. In the events and notes sections, Darrell, what do we see? You have this book column here that's highlighted in yellow. Okay, so let me just click on that. What does this do? This keeps a record for me. It says on 6/28/2019, I bought 500 shares of UTHR. I sold 20 contracts of the 80 strike call, bought 15 contracts of the 85 strike call. And then you can add more events. So every time you do an event, enter that trade, Darrell, roll it, close it, add protection to it. It'll automatically keep the event, date, and time with what action you did listed here. And then I can edit it in there. Wanted to spell correctly. Wanted to take a look at a ratio bear call against a long stock position. Nothing naked, as shorts are covered by stock. Okay? Simple as that. Now I'm going to go ahead and save the note. There we go. Now, once this is done, it's a position history here, but once that's done, I go back and it'll be listed on all of these. Now, let's say I didn't like this structure anymore. Something about it makes me nervous, and let's say we got a small gain. These short calls drop down to $1.10. I make a change. So I'm going to go to Position Actions here, and I'm going to close my short leg. But I don't want to close 10. I'll leave the other 10 open, but I'm just going to close 10 for, I know this isn't realistic, I'm just using it as an example. For 110, I'm going to take 53 cents of profit after 10 of those contracts that we sold. Okay, so now what do we have? I've got 10 contracts short, 15 contracts long, 500 long as well. And I go and click the book icon here, Darrell. There we go. An event, close the following leg, bought to close 10 contracts of UTHR at 110, stock price at the time of trade, 78.06. It records that as well. Add note. Could take 50 cents of profit on my short calls, which also canceled the risk of being short shares. Actually, I would have bought back more. Being short shares if stock between two call strike prices. All right. So now once again, that is in there. I can choose to delete it. I can edit the note. I can add more to it. That's my trading journal. That's exactly how I use this tool. This is my webinar account. Not one that I keep up with actively. Sometimes that we do. Sometimes we do, sometimes we don't. But as trades are, oh yeah, that's way past. Let's see here. Where's a good one? Oh, Goose. Even though Goose expired and I didn't close this out, as you can see, what I said, I don't keep an active of this. We use it for the webinars and so forth. It's not my actual account on PowerOptions. But let's go into the notes for GOOS. So let's click on the notes. There we go. Now this should be, in theory, be a closed position because the put past expiration. But see, here you go. Here's all the trading notes I did for this position. I could have added more to it. But you see, stock price at the time of trade, following leg expired. I sold one contract September 57.50 at $1.15 when the stock was at 60.77. Bought a 64 call here. Okay, so everything that I did with the puts, with the calls, if I'm rolling calendars, if I'm rolling straddles and strangles, when I sold against them, anytime you make an adjustment to the position, Darrell, it puts in an event automatically for you. You can go into the book icon in the notes section and change any of the notes, or if you made a mistake and don't want it in here, you can delete the event just like you delete the leg inside the portfolio. But that's all in the events and notes section. and just click the little book icon on each one to see your activity, and you can add or subtract from that note any way you want to as you're going through the different positions and making different adjustments. Or let's say you're following a specific trading plan that has a specific list of rules and you want to jot down when you did an adjustment based on what rule was hit. For radioactive trading, I might say, hey, I entered this income method number 6. I sold to open the 80 call and bought to open the 85. And then I could add in my note and say, this is an income method number 6 because the stock moved up towards my put strike price. I saw an opportunity to generate premium, but I didn't want to just cap the upside as I would with income method number 1. So I used income method number 6 to generate a little bit less premium, but still leave the upside open. Simple note, simple thing that I would send to the Fusion subscribers as a brief when I make an adjustment to my married put trade. And that's what I'd probably put in the notes in my personal portfolio at PowerOptions as well, the information I included, the brief for the Fusion subscribers. I hope that answers your question, Darrell, both about the portfolio tool and the notes, and what is the outcome of the UTHR ratio bear call spread. Even though you already own 500 shares, it has the same effect. Look at it this way. It has the same effect of a 15 contract bear call spread, where you have to receive the full loss on the bear call if it's above both strike prices, and you'd be assigned stock at your price, let's say 80. And if it's between the strikes, though, you may end up being short 1,500 shares of stock after assignment, because that's the obligation of the short call, and you're out of the money. 85 call would just expire worthless. You'd have to cover that 15 contract short of the 20 you sold that wasn't covered by the stock. Okay, well, ladies and gentlemen, I just want to throw this out there. It is 5:21 p.m. Eastern Time. As I mentioned, I'm always happy to stay on longer if we have any other questions, but right now I don't see any new questions that have come in. We handled Jerry's questions. We took a look at some of Darrell's questions as well, and we also reviewed what we discussed with Fernando also. So if anyone has any last-minute questions, go ahead and send those in. As we talked last week, we saw that the market sentiment tool had gone into that sell warning back on 6/20, on Thursday, just before Friday's presentation. Our last archived webinar, it was the very last, maybe 30 minutes or so, we discussed how we use this tool, what actions we take when we see a light buy, or when we see several sell warnings or a few sell warnings appear at a time. This one we only saw the one and then went back to neutral. So I didn't really make an action on my positions based on that one sell warning. I was alerted to it. I was waiting for other follow-ups, but I didn't really see it in that case. But you can access that anytime if you're logged on to PowerOptions. And of course, just go to your free webinars page and go to requested topics. Oh, okay, these, the most recent one here, I'm going to change that. That should be available for trialers right now, but it's not. I think the programmer made a mistake. He was supposed to use, oh, okay, he did those 3. Okay, but I'll talk to him about that. It should be reversed. It should be a little bit reversed. The top one should be available and the other shouldn't. Anyway, I'll just leave that there. Okay. Oh, yeah, I can't read the... One second. I do have this other question. It's related to the archive. Yes, this webinar will be archived. Most likely will be posted on Sunday, possibly Saturday, but I'm not going to promise that. But I'm going to try to get it up Saturday for you all. As always, when the webinar is archived, if you're currently on a trial or subscription, as I mentioned, you can access it in the requested topics. I'll send everyone an email. The same. All of you that got the email today for the webinar invite, you'll receive the same email when the webinar is posted. You don't have to access it here. You're going to be able to access it on the YouTube channel. So you can just go to PowerOptions YouTube there, and it will be available as the public presentation also. So you'll be able to access that at any time. Okay. So yeah, once it's posted, probably be Saturday, more likely Sunday. I hate to say it. Looking at my schedule this week, but most likely as well. Oh, great question, Fernando. I'm sorry, I didn't finish that part of our topic of our conversation. I really should have, and I'll get to that in just one moment. Okay. There we go. This is what I needed to do. Sorry, folks. Shrikant, yes, sorry, I couldn't see the name of the way that it was being truncated. So Shrikant, yes, this will be archived. You'll be able to access it. When I send out the email, you have a link to the webinars page to log on and view it, or you can, I include the link for YouTube as well, so you can just watch it at YouTube and it's a public video. Let's see, Darrell says, very helpful. I was early assigned ANF and UTHR at a 6K loss on each one. That's the genesis of my question. Okay, but helpful explanations. Yeah, it's probably because it was a bear call spread, so if it was above both strike prices, you took a hit on those as well. We're going to go back now to our discussion on sort of theta positive things in relation to what we were talking about with, let's see here, Fernando a while back. And we were using the example, I've got to go back to it, EDU. Okay. All right, so EDU, here's that original married put we were looking at. Prices are different now, but it's still close to the same risk with 7.7, 7.9%. Okay. Another positive theta position you can use went against Fernando's discussion. What did he want from me? He wanted to say, is there a way that I can be in a directional protected position, be theta positive, but still leave the upside open in the original direction? And I walked him through how that would change, and that yes, the married put with income method number 6 might put you in a positive theta position, but it's really small and it does change the dynamic of the trade. You have to make sure it matches your expectations. A real simple theta positive position, protected, is a collar. So with our stock at 96, I might sell the 100 call and buy the 90 put. Why not the 95? The stock's at 96.58, so the 95 probably has a higher theta, and I'm buying the put and selling the call. This is your standard collar. Okay, so we're selling there and we're buying the 90 to keep theta positive, keep a premium, relatively controlled risk, good positive return if it moves up. Our break even's just a little bit below where the stock price is right now. We get that positive 75 cents net credit in this case. All right. Now, what doesn't it do? For Fernando, it doesn't leave the upside open. And you look at your standard collar theta, this has to be positive because the short call should have a higher theta than the put you bought. But again, if I had bought the 95 put too close, it wouldn't be. So here's my theta 0.08 on my call. Remember, that's a positive theta. It's negative, but I sold it. It says positive theta decay in my favor on the call. The put, once again, research, option research here, shows me all of the data for that. And the theta's 0.0573. All right, so we're at a positive theta of about 0.23. I'm sorry, 0.0023, right about where we were. I think the other put that we were thinking of using the 95 put, that would have a much higher theta, so we wouldn't be theta positive. But here would be a small amount, again, 2.002. So about 0.02 of a cent positive theta per day for the next 21 days, and that would change as we got closer to expiration. Okay. Now, what I also mentioned to Fernando was, and it's tough with this one, but I mentioned something called a conversion. A conversion is simply a collar, meaning that you own stock. You're selling a call and you're buying a put, typically with the same or a conversion, it has to be the same expiration just as a standard collar, but you're using the same strike price. So I'd sell a 95 call at 4 and buy a 95 put at 230. I don't think I could do the hundreds in this case, but we might take a look. All right. This is what's called a conversion. It's only done in one situation. Since I'm not right at the exact strike price, Fernando, this is only done when the time value of the call is greater than the time value of the put. In this case, it is. Okay. So yeah, I'm getting a $2 $1.80 some net credit, $1.70 some net credit, $1.73 net credit, but remember, I'm $1.58 in the money. But this gives me about 15 cents positive time value premium And it doesn't like what I'm doing to it right now, so let me try it again. I think I had this issue before a long time ago. It should. All right, I'm not going to scroll. I'm going to submit it and just let it sit. What this does, Fernando, is it draws a straight line profit and loss chart. Meaning what? Yay, there it is. This one's actually good if you can get these prices. Well, it's not good. This one is what you need, excuse me, to do it. It's a positive straight line profit and loss chart with a max profit of $14, meaning 14 cents. That's a conversion. Guaranteed profit, as I said in my email, of 0.1% or less. If the stock's above 95, the put expires, you get assigned on the call, but your cost basis was 94.86. You make 14 cents of profit, or 0.1%. Stock's below 95. The call expires worthless. You exercise the put. You make 14 cents, 0.1%. The stock could go up to 800. You get assigned on the call and make $14. The stock could go to 10 cents. You exercise the put, make $14. When is it convenient to use it? As I mentioned in the email, for retail investors, not very much. Okay? You need big volumes, but now think of it. In order to make this profitable, I say, what do I need for $14 to make this profitable? Well, I got to go up to 5,000 shares and at least 50 contracts. What's your commission now? For 50 contracts of a call, 50 contracts of a put, and 5,000 shares. Are you even close to the profit that you need? This is a tricky one. Okay, conversions are available. Conversions can be shown if you can get the right prices, and usually you can, although the market maker is going to fight you to try to dupe you in at maybe midpoint prices and then not give you that. But here's the trick of it. Does it make sense for a retail investor? Most of the time it doesn't. Not even high volumes, but then you got to factor in all your commissions, and you think the stock's just going to be stable and move in this direction or this direction. There's probably better strategies and better positions and better stocks out there to use. You say, why not go further out in time? If a conversion is available near term, can't we get more premium far term? Not necessarily. Now, let me clear those out first. Because the volatility, the implied volatility of the options are also going to change. In some cases, you might see a higher implied volatility on the calls than on the puts. And this one does look like it's going to give a good credit and is going to be higher, but it's going to be close. So I'll go out to October. Okay. Now we're at 0.4%. That's not bad. We've increased our return by 3%, threefold, from 14 cents to 42. At midpoint, it's still a guaranteed profit, straight line profit and loss chart. Let me submit that again without scrolling. I don't know if that's the issue or not, but let's see if it builds that straight line profit and loss chart for us. But it's 42 cents against 100 shares. It's 0.4% of whatever you're investing. It's not just the volumes you need for profit. What is the return? For 180 days out to October, I'm sorry, it's not that far, 180 days. It's 120 days out to October, it's 0.4%. If I do 10,000 shares, sell 100 calls, and buy 100 puts, I'm still only making 0.4% for 120 days of investment. It's probably not going to match my trading plan. But that's what a conversion is. When do you use it? I don't. If I see a skew, if something comes on, Sears Holdings had a really strange skew for a while that was conducive if you wanted to do it for the short. It's called a reversal. It's not called a short conversion. It's called a reversal. Instead of a caller doing a short caller with the same strike prices, meaning I'd short the stock, sell the put, and buy the call. Okay, but again, that's what it would work there. All right, so that's why it's not, the conversion is not really conducive unless you see something that's extremely out of the ordinary and gives you something that's a little bit better, 0.5, 0.6% return for 1 month, which is almost impossible to find. But test it out. How are you going to test it out? Go to long collar. Go to search. Scroll down. See our defaults here. So many defaults: debit collars, different months, calendar collars, for example, reverse long collar, and conversions. It's the first one, of course. So I do have a search here for conversions over about a 50-day time frame. Yeah. And there's some here that are showing promise at midpoint, but that's, again, if you get filled at midpoint. And it's most of these are 50 days out of time, so it's a 0.7% return possibly for 49, 59 days. Might match your goals again, but it might not, depending on the prices that you can get. Going back one other conversation, okay, here, Darrell asks something, and again, I don't know if these were your prices, right? I showed an example of what it would look like, Darrell, based on what you asked. You were selling 20 and buying 15. Okay, so we sold 20, bought 15. And you said you wanted to buy out of the money calls. You know, you said you were signed at some point, so I think you had tried the strategy. And here's the deal. What Darrell asks now is, I'm going back to that idea if the stock was at 83 and you're going to end up being short 1,500 shares of UTHR at expiration if you don't manage it in time and be assigned the stock. Darrell made a comment, would exercising my long calls be useful? No. I didn't think you had long calls that were the money. Here's the deal. What does a long call do if you exercise it? It gives you the right to buy shares of stock at that price. If the stock's at 83.34, you can't even exercise your 85 calls. And then the other problem is you wouldn't even do that. You're denying yourself $1.60 of profit, or you're adding $1.60 of cost. If your long calls are still out of the money, you do not exercise them. Okay? It's cheaper to actually pay the money to buy these short calls back. So the stock's at 83.34. Your 80 calls are going to be worth 334, or you end up being short 1,500 shares. Okay, so let's say you were short 1,500 shares at that point, Darrell. Okay, you got assigned early and you're short the 1,500 shares, remember, at 80. Buying 1,500 shares at 83.34 to cover this obligation, you lose 334. If you exercise the 85s, which you couldn't even do if they were out of the money, but if you exercise the 85s, why would you pay $85 for stock that's trading at 83.34 at market? Now, if your example is different, you tried this strategy already, now you're signed, and now you don't know what to do, and the stock is trading, let's say, 90, yeah, absolutely. You exercise these to cut your losses. You can't lose any more. Your hope is that the stock pulls back below that price and you can maybe buy the shares back. But at this point, if you're short stock at 80, the stock's at 90, and you're holding those 85 calls, yeah, absolutely. Exercise these, get out of this position, take your loss, move on. That way you don't have to worry about the short stock position in your portfolio anymore if you don't want to have it. But if you think it could pull back, and it could pull back to a lower price than what you were assigned on the shorts, now carrying short shares of stock, then you can wait. But eventually, yeah, exercise it. But never, I don't even think your broker will let you exercise the 85s as the stock's trading at 83.34. Let's buy the shares of stock at 83.34 to close the obligation. It's just the opposite transaction. That's all it does. Okay? So if it's out of the money, still don't exercise it. Buy it at market at the cheaper price. I'm sorry, I know you can hear me all clicking there. I just wanted to make sure of something. All right. Well, that takes care of the Darrell's follow-up and Fernando's follow-up as well. It's 5:38 p.m. Eastern time. I don't see any other questions coming through. Once again, I want to remind everyone about our short trading week next week. Markets will close early on Wednesday, July 3rd, about 1 o'clock. And the markets will be closed Thursday, July 4th. Happy Independence Day as well. Side note, I want to remind everyone, of course, that today's material are my thoughts on your questions. Isn't that better? That's better. Okay, so quick reminder one more time. There we go. Markets closed July 3rd. Close early, July 3rd around 1 o'clock. Markets closed Thursday, July 4th. And today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options trading knowledge. Any stocks discussed today, EDU, UTHR, for example, we saw on the Married Put screen, PAGS for Jerry, are not direct recommendations or suggestions. They're ideas on the structure that we would trade and what we would look for as far as keeping risk controlled, but in addition to that, generating premium and remembering that if we're trying to add Greek components to our portfolio by staying delta positive, delta negative, delta neutral, theta positive, theta negative, theta neutral, gamma positive, negative, or neutral. Remember what happens when you start adding those things in. You're changing the dynamic of the trade. You still have to pay attention to your rights and obligations to make sure it matches your risk tolerance and your sentiment for the underlying security. Sometimes it might not be worth it to force a theta positive position if the new structure you have to do to get to that theta positive position no longer matches your expectations going forward. As we saw today, different structures and different things involve risk. Options involve risk and may not be suitable for all investors. For those of you that maybe haven't seen PowerOptions before, you saw some of the tools today. We took a look at the search. We saw some of the signature tools briefly. We looked at the portfolio tools to help you track, manage, and analyze your positions as well and keep that trading journal. You want to test it out anytime, just go to PowerOp.com, put in your name and email address, and you can test the site for 14 days, no credit card required. After that, subscription start at $45 per month, and then we do offer real-time service, real-time data every time you submit a search or refresh the page, and access to our historical suite of tools for backtesting purposes, and our historical data goes back to April of 2006. Other free education, well, we talked about the webinars page as well. Once this webinar is put up, converted, written up, and put up, we'll send everyone an email letting you know where you can access it on the PowerOptions webinars page or on YouTube, of course. You can always check that out at powerop.com/webinars.asp. Other free articles, just go to blog.powerop.com, read through some of our write-ups as well. And of course, you can check out our YouTube channel at any time. Now, if you think of any questions later on this weekend, anything that we discussed today, want to follow up on, remember you can send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. You are 100% likely to get either myself or Ernie directly. I shouldn't say 100%, 50-50 shot of getting me or Ernie directly. And if we're not available because we're on coaching sessions or other things, we'll get back to you right away as soon as we can. So you're not just talking to a call center, you're actually talking to myself, or you'll be talking to Ernie, the president and founder of PowerOptions. And of course, any trial member and subscriber can schedule one of those coaching sessions at any time. Again, that's a 35, 40-minute phone conversation. We'll walk you through the tools on the site, answer any questions you have about a strategy, management techniques, or more. And again, the only two people that handle the coaching sessions are myself and Ernie. So you're getting someone that is experienced in options trading and knows the site inside and out either way. Ladies and gentlemen, thank you once again for your time. Thank you for your questions. Everyone have a fantastic weekend. We'll see you next Friday, again at 4:30 p.m. Eastern Time after the July 4th holiday here in the United States as well. And I look forward to seeing you all then. Take care, everyone. Good night.